In 2008, a Wall Street trader put his entire life savings into a single trade. He was 100% sure he was right. 3 days later, his account hit zero. Millions of dollars gone. This wasn't some amateur. This was a top analyst who understood numbers better than most people ever will. So here's the real question. If the smartest people can lose everything, are you actually safe? Most people assume market losses come from a lack of knowledge. But the truth is, the biggest losses usually happen to the most confident people. And that's because of a thin, dangerous line between confidence and overconfidence, a line that's almost impossible to see until it's already too late. Confidence is healthy. Confidence says, I've done the research, I understand the risk, and I'm making this decision based on that risk. It's a grounded feeling, built on evidence, built on preparation. Overconfidence is something completely different. Overconfidence says, I know what's going to happen next. That's not confidence anymore, that's a prediction. And the market never lets anyone predict the future with certainty, no matter how experienced they are. Psychologists call this the illusion of control. When someone makes the same kind of decision over and over, whether it's stocks, crypto, or even sports betting, the brain starts building a story. It tells you, I'm seeing a pattern. I've figured out the system. In reality, most of the time, that person is just mistaking coincidence for skill. The brain is wired to find patterns, even in pure randomness, because pattern recognition kept our ancestors alive. But in the market, that same instinct can quietly destroy you. There's another concept called the Dunning-Kruger effect. It means the less someone actually understands something, the more confident they tend to feel about it. When a new trader enters the market and gets lucky 2 or 3 times early on, their confidence shoots through the roof, but their actual knowledge is still at a beginner level. The gap between how much they think they know and how much they actually know keeps growing quietly in the background until something forces it into the open. This gets even more dangerous when you add something called self-attribution bias. When a trade goes well, the brain says, that happened because I'm skilled. When a trade goes badly, the brain says, that happened because of bad luck, or the market was rigged, or the news was unfair. Notice what's happening there. Wins get credited to skill. Losses get blamed on outside factors. Over time, this creates a completely distorted picture of your own ability, one that's always inflated, never corrected, because every piece of evidence gets filtered through a story that protects the ego. There's a related idea worth understanding here too, called confirmation bias. Once someone forms a belief about where a stock is headed, their brain starts hunting for information that supports that belief, and quietly ignoring anything that contradicts it. If you believe a company is about to take off, you'll notice every positive headline and dismiss every warning sign as noise. This isn't dishonesty. It's just how the brain naturally protects a belief it's already emotionally attached to. And the stronger the initial confidence, the stronger this filtering becomes. Let's look at a few real cases, because these patterns show up again and again throughout history, in almost identical shapes, just with different names and different decades. Back in 1998, there was a hedge fund called Long-Term Capital Management. It was run by 2 Nobel Prize winners, some of the smartest minds in the world. They had the best models, the most advanced math. Everyone believed this fund could never fail, but overconfidence convinced them they had calculated every possible risk. Within a few weeks, the fund lost billions of dollars, and it shook the entire global financial system, forcing a bailout just to prevent a wider collapse. Fast forward to 2021, and you see the same psychology play out with meme stocks. Retail investors piled into a handful of companies, watched the price rocket upward in days, and genuinely believed they had discovered a new kind of investing strategy. Some of them made real money early on, but that early win created a false sense of mastery. Many of the same people who made money in the first wave lost it all, and more in the second wave, because they were convinced the pattern would simply repeat itself forever. It didn't, and the ones who lost the most were often the ones who had been the most confident just weeks earlier. And then there's the story of Enron, a company once celebrated as one of the most innovative businesses in America. Executives were so confident in their own strategies, so sure that the numbers would eventually work out, that they kept doubling down instead of stepping back. That confidence, unchecked, turned into one of the largest corporate collapses in history, wiping out thousands of jobs and retirement savings almost overnight. There's also the case of a well-known hedge fund manager who, in the years leading up to 2008, made an enormous correct call against the housing market and made a fortune doing it. That win was based on genuine research and real insight. But years later, that same overwhelming confidence, the belief that he could once again see something the rest of the market was missing, led him into a series of much weaker bets that didn't pay off nearly as well. Being right once doesn't mean the same level of certainty is justified the next time, but the brain rarely makes that distinction on its own. Even outside of trading, this same psychology shows up in everyday financial decisions. Think about someone who takes on a large mortgage because they're confident their income will keep rising, or someone who quits a stable job to chase a business idea, certain that success is guaranteed within a year. These aren't market crashes, but they follow the exact same psychological blueprint. A strong belief in a specific outcome, built on limited information, treated as if it were guaranteed. Notice the pattern connecting all of these stories. It was never a lack of intelligence. It was never a lack of information. It was the inability to separate what they actually knew from what they simply believed they knew. Intelligence doesn't protect you from overconfidence. In fact, sometimes intelligence is exactly what makes overconfidence worse, because smart people are better at building convincing justifications for decisions that are actually driven by emotion. A smart person doesn't just feel confident, they can construct an entire logical argument to defend that confidence, which makes the overconfidence even harder to notice from the inside. This is sometimes called the smart person's trap. The more articulate someone is, the more convincing their bad decisions can sound, even to themselves. So how do you tell the difference between confidence and overconfidence in your own decisions? There are a few clear signs to watch for. The first sign is when someone stops questioning their own decisions. Healthy confidence always asks, could I be wrong? What am I not seeing? Overconfidence stops asking that question entirely. It replaces curiosity with certainty. The second sign is ignoring risk management. When someone thinks, this time won't end in a loss, and stops setting stop losses, or stops diversifying, or starts putting in money they can't afford to lose, that's exactly where danger begins. The third sign is completely dismissing advice from experienced people, treating every warning as outdated thinking instead of useful perspective. This often shows up as irritation, getting defensive the moment someone questions the plan. The fourth sign is something called the gambler's fallacy, the belief that after a string of losses, a win is somehow due. This feeling convinces people to keep going, to keep increasing their bets because surely the tide has to turn soon. Mathematically, it almost never works the way the brain imagines it will, because each new decision is largely independent of the last. The fifth sign is overtrading, constantly checking prices, constantly making small adjustments because sitting still feels like losing control. Confidence can wait patiently. Overconfidence feels the need to act constantly, just to feel in charge of the outcome. The sixth sign is talking about a decision in absolutes. Phrases like, this can't fail, or there's no way this goes down, are almost always a signal that logic has been replaced by emotional certainty. Real analysis almost always leaves room for the possibility of being wrong. And the seventh, most dangerous sign is taking on even bigger risk after a loss, just to try and recover it fast. In psychology, this is called loss chasing. And this is the exact point where most people lose everything, not during their first mistake, but during the desperate attempt to undo it. Here's what's interesting. Overconfidence usually shows up after success, not after failure. When someone gets a few good results early on, the brain's reward system lights up. Dopamine gets released, and the brain starts chasing that same feeling again and again, the same way it chases any other rewarding experience. That's why the biggest losses often happen right after the biggest wins, when guard is down and certainty is at its peak. There's also something called hindsight bias worth understanding here. After an event happens, the brain convinces you that you basically knew it all along. If a stock crashes, people say, I had a feeling about that. If it goes up, people say, I knew it would happen. This rewriting of memory makes people feel like better predictors than they actually are, which then fuels even more overconfidence the next time around, creating a cycle that keeps repeating unless someone consciously interrupts it. One more piece worth understanding is something called the planning fallacy, closely related to overconfidence. It's the tendency to underestimate how long something will take, or how much it will cost, or how difficult it will be, even when past experience should have taught otherwise. Someone might tell themselves, I'll only need 6 months of runway for this investment to pay off, even though every similar situation in the past took twice as long. The brain consistently favors the optimistic version of the future, especially when it's the version that requires the least discomfort right now. So the real question is, how do you stop confidence from turning into overconfidence? First, always set a fixed risk limit before you make a decision, not after, no matter how sure you feel in the moment. Decide your limit while you're calm, not while you're emotionally invested in an outcome. Second, review your past decisions honestly. Look closely at what was actual skill, and what was just luck disguised as skill. Keep a simple record if you can, because memory alone will always favor the version of events that makes you look good. Third, always keep people around you who challenge your thinking, not just people who agree with you. An echo chamber feels comfortable, but it's one of the fastest ways to lose touch with reality. Fourth, learn to recognize the emotional high that follows a win, and treat it as a warning sign rather than a reward. That high is exactly when the brain is most likely to make a reckless decision. Fifth, build in a mandatory pause before any major financial decision, even just 24 hours. That short gap gives the rational part of the brain time to catch up with the emotional part, which almost always moves first. Sixth, actively search for reasons you might be wrong before committing to a decision, instead of only searching for reasons you're right. This single habit, done consistently, is one of the strongest protections against overconfidence that exists. And seventh, the most important one, understand that admitting you're wrong in the market isn't weakness. It's part of every successful investor's journey. The people who last the longest aren't the ones who are always right. They're the ones who catch themselves quickly when they're wrong and adjust before the damage becomes permanent. Financial success isn't just a numbers game, it's a mind game. The market doesn't reward the smartest person in the room. It rewards the person who understands their own psychology well enough not to become their own biggest risk. The trader who lost everything in 2008 wasn't missing intelligence, he was missing self-awareness. And that gap, more than any other single factor, is what separates the people who build lasting wealth from the people who lose it all trying to prove they were right. The uncomfortable truth is, everyone watching this video has some version of this pattern running quietly in the background of their own decisions, not just in trading, but in career choices, business decisions, and everyday spending. The goal isn't to eliminate confidence completely. Confidence is necessary to take any risk at all. The goal is to build in just enough self-doubt, just enough friction, to catch the moment confidence quietly crosses over into something far more dangerous. If this video gave you value, make sure to subscribe to the channel, because we're going deeper into financial psychology topics like this one, the kind that can completely change the way you think about money, decisions, and risk.